Still renting? Here's how to buy without breaking the bank. Boost your credit, explore first-time buyer programs, and negotiate closing costs. Homeownership is closer than you think. Start smart, not stressed. Do you ever feel like you're just setting your money on fire every month with rent? You see other people buying homes and you just can't figure out how they're doing it? For you, it feels like a total financial fantasy. I've been there. I know that feeling of being trapped, writing that check to your landlord every month, knowing it's not building a single ounce of equity for your own future. It's frustrating. It almost feels hopeless. You feel like you're on a treadmill, running as fast as you can just to stay in the same place, while the dream of owning a home just drifts further away. For years, I was convinced home ownership was a club I just wasn't invited to. I thought you needed a six-figure salary, a flawless credit score, and a giant pile of cash just to get your foot in the door. The jargon, the scary headlines about interest rates, it all felt like it was designed to keep people like me out. But what if I told you that most of what you believe about buying a home is either outdated or just flat out wrong? What if the biggest barrier isn't your bank account, but the information you have? In this video, I'm going to show you step by step how to build a rock-solid financial foundation that turns that dream of owning a home into a reality. And you can do it without breaking the bank. This isn't about winning the lottery. This is a real, tangible roadmap. We're going to tear down the myths, simplify the confusing stuff, and create a clear, actionable plan that will take you from renter to homeowner. By the end of this video, you won't just believe it's possible, you'll have the exact steps you need to start your journey today. The mindset shift, from renter to future owner. Before we get into the numbers and the loan applications, we have to start with the most important piece of the puzzle, your mindset. Right now, you probably see yourself as a renter. It's an identity, and it shapes how you think about your money and what you believe is possible. The very first step on this journey is to consciously change that identity. Starting today, you are no longer just a renter. You are a homeowner in training. Now, this isn't just some feel-good nonsense. It's a real psychological shift that will change your behavior. Think about it. A renter pays their rent and calls the landlord when things break. A homeowner in training, on the other hand, sees every financial choice through the lens of their future home. That $150 dinner out isn't just a meal, it's a chunk of the down payment fund. That subscription you barely use, that's money that could be boosting your credit score. That feeling of being trapped by rent is completely valid. It can feel like you're paying your landlord's mortgage, building their wealth while yours goes nowhere. Acknowledging that frustration is powerful. Use it as fuel, but you can't live in the frustration. You have to channel that energy into action. The story in your head has to change from, I can't afford a house, to, what do I need to do to afford a house? That simple question puts you in the driver's seat. For the next week, I want you to practice this. Every time you think about your living situation, correct yourself. You're not stuck renting. You're strategically saving while preparing to buy. This little mind game does two things. First, it makes your current rental feel temporary and purposeful. It's a launch pad, not a dead end. Second, it gets you ready for the responsibilities of owning a home. You start thinking about your finances in terms of long-term assets, not just monthly bills. Building equity starts in your head long before you get the keys. It starts right now with the decision to invest in yourself. The financial MRI, assessing your true situation. All right, with that homeowner in training mindset locked in, it's time for action. We're going to conduct a full financial MRI. This is the one step you absolutely cannot skip because you can't map out a route if you don't know where you're starting from. A lot of people avoid this because they're afraid of what they'll find. But clarity, even when it's uncomfortable, is your biggest advantage. We're going to look at everything: income, expenses, debt, and savings to get a brutally honest picture of your financial health. First up, income. This seems simple, but you have to be precise. Grab your pay stubs from the last few months. If you're salaried, it's easy. If you're hourly, a freelancer, or have a variable income, you need to calculate an average. Lenders will want to see a 2-year history for that kind of income, so get used to thinking in those terms. Add up your gross monthly income. That's the number before taxes and deductions. It's the number lenders care about most. Next, the fun part, tracking your spending. For the next 30 days, you're going to become a financial detective. You need to track every single dollar that leaves your bank account. Use an app, a spreadsheet, a notebook. I don't care what tool you use, just be consistent. Categorize everything: rent, utilities, groceries, gas, student loans, car payments, credit cards, subscriptions, that morning coffee, everything. The goal is to go from "I think I spend around" to "I know for a fact I spend exactly." This step alone will be a huge wake-up call. You'll find the budget leaks, those small, frequent expenses that add up to hundreds of dollars a month. Don't judge yourself, just gather the data. Once you have a month of data, it's time to build a real budget. Income at the top. Then list your fixed expenses, the bills that are the same every month, like rent and car payments. Then list your variable expenses, the ones that change, like groceries and gas, using the average you track. Finally, list your discretionary spending, the wants, like dining out and shopping. Subtract your total expenses from your income. The number you're left with is your current monthly savings potential. It might be positive, it might be negative, whatever it is, that's your starting line. Last piece of the MRI, a snapshot of your debts and savings. Make a list of all your debts, student loans, car loans, credit cards, everything. For each, write down the total balance, the minimum monthly payment, and the interest rate. This will be critical later. On the other side, list your assets. How much is in checking, savings, any investments? Be honest. At the end of this, you'll have a document that tells the complete story of your financial life. It might feel like a lot of work, and yeah, it might be a little scary, but you've just done something 90% of people never will. You've replaced anxiety with facts. You now have the map. And from here on out, every decision can be strategic. Step 2, the credit score comeback, your key to better loans. If the financial MRI was about your present, this step is about your future. We're talking about your credit score. This little 3-digit number is one of the most powerful factors in your home buying journey. It's not just about getting a yes or no on a mortgage. It's the key that unlocks lower interest rates, better terms, and a smaller monthly payment. A few points here can save you tens of thousands of dollars over the life of your loan. So let's pull back the curtain on this number and build a plan to pump it up. First, what even is a credit score? It's a number usually from 300 to 850 that tells lenders how likely you are to pay back your debts. It's based on 5 main things: your payment history, do you pay on time, amounts owed, how much of your credit limit are you using, length of your credit history, your mix of credit types, and any new credit you've applied for. Your first move is to get your credit reports. You can get them for free once a year from each of the 3 main bureaus, Equifax, Experian, and TransUnion, at the official site annualcreditreport.com. Once you have them, go through them line by line. Look for mistakes, an account that isn't yours, a late payment you know you paid on time. Disputing errors is the fastest, easiest way to potentially boost your score. Now let's focus on the 2 biggest things you can control: your payment history and how much credit you're using. Payment history is the heavyweight champ, making up about 35% of your score. If you have any accounts that are past due, your absolute #1 priority is to get them current. If you forget due dates, set up automatic payments for at least the minimum on everything. One 30-day late payment can tank your score for a long time. The next biggest factor, and the one you can change the fastest, is your credit utilization ratio. This is about 30% of your score, and it's just the amount of credit card debt you have divided by your total credit limits. If you have a $2,000 balance on a card with a $10,000 limit, your utilization is 20%. The golden rule is to keep it below 30%, but the real magic happens when you get it under 10%. Here's a game plan to crush this. 1. List out your credit cards, balance, limit, and utilization ratio for each. 2. Target the highest utilization cards first. Paying down a card that's at 90% utilization will give you a bigger, faster score boost than paying on a card that's already at 40%, even if the interest rate is lower. 3. Make multiple small payments. You don't have to wait for the bill. If you get paid twice a month, make a payment on both paydays. This keeps your reported balance low. 4. Ask for a credit limit increase. If you've been a good customer, call your credit card company and ask for a higher limit. If your limit doubles but your balance stays the same, you've just cut your utilization in half. Just be disciplined. This isn't a license to shop. A couple of other quick tips. Do not close old credit cards. After paying one off, it feels good to close it, but don't. Closing an old account can shorten your credit history and lower your available credit, which actually increases your utilization ratio and can hurt your score. Just shred the card if you don't trust yourself with it. Become an authorized user. If you have a parent or trusted family member with a long, perfect payment history on a credit card, ask them to add you as an authorized user. Their good habits can start showing up on your report and give you a nice boost. Avoid opening new credit. In the 6 to 12 months before you plan to buy, don't apply for new store cards or car loans. Every application can cause a small temporary dip in your score. For a conventional loan, you'll generally want a score of at least 620. For an FHA loan, you can often get approved with a 580 if you have a 3.5% down payment. If your score is between 500 and 579, you might still get an FHA loan, but you'll probably need a 10% down payment. The higher your score, the better your options. Every single point counts. Step 3, the DTI diet, trimming your debt to income ratio. We've analyzed our money and started on our credit. Now let's tackle the third pillar of getting a mortgage, your debt to income ratio, or DTI. It sounds like boring financial jargon, but it's actually simple, and it's something you have a ton of control over. Your DTI is basically a financial stress test that lenders use to see if you can safely handle a mortgage payment. So what is it? It's the percentage of your gross monthly income, your pay before taxes, that goes toward paying your monthly debts. Lenders look at 2 types. 1, front-end DTI. This is just your future housing payment, the mortgage, taxes, and insurance. Lenders like to see this at or below 28%. 2, back-end DTI. This is the big one. It's all your monthly debts combined, the future mortgage payment, plus your car loan, student loans, minimum credit card payments, etc. To find your DTI, you just add up all those monthly debt payments and divide by your gross monthly income. Let's say you make $6,000 a month before taxes. Your debts are a $400 car payment, a $200 student loan payment, and $100 in credit card minimums. Your total monthly debt is $700. Right now, your DTI is $700 divided by $6,000, which is about 11.7%. But when a lender qualifies you, they add the proposed mortgage. If that new house payment is $2,000, your new total monthly debt becomes $2,700, $700 plus $2,000. Your DTI then jumps to 45%, $2,700 divided by $6,000. Why does this matter? Lenders have strict limits. Generally, they want your back-end DTI to be 45% or less for a conventional loan. For government-backed loans like FHA, they can sometimes be more flexible. going up to 43%, maybe even as high as 57% if you have other strengths like a great credit score or a lot of cash and savings. But the lower your DTI, the less risky you look and the more house you can afford. If your DTI is too high, you have two choices: make more money or have less debt. Making more money is great, but lowering your debt is usually faster. It's time for a debt diet. Look back at that debt list from your financial MRI. Your goal is to kill off as many of those monthly payments as you can. Here are two popular ways to do it. The debt snowball. You pay off your smallest debts first for the quick psychological win. Make minimum payments on everything else and throw every extra dollar at the smallest balance. Once it's gone, you roll that payment onto the next smallest debt. The momentum feels great, the debt avalanche. This is the math nerd way. You attack the debt with the highest interest rate first, which saves you the most money over time. Which one is better? The one you'll actually stick with. A few key things to think about. Don't rush to pay off your car. I know this sounds crazy, but if your car loan has a low interest rate and a long history of on-time payments, it's actually helping your credit mix. Paying it off could deplete cash you need for the down payment and cause a small temporary dip in your credit score. Talk to a lender before you wipe it out. Focus on credit cards. Paying off a credit card completely eliminates that minimum payment from your DTI calculation. This instantly frees up room in your budget, and as a huge bonus, it slashes your credit utilization, which will boost your credit score. Think in terms of payment to purchase power. Every $100 in monthly debt you eliminate can potentially boost your home purchasing power by $15,000 to $20,000. Thinking about it that way makes it a lot easier to skip eating out for a while. Getting your DTI in shape shows lenders you're disciplined and can handle the responsibility of a mortgage. Step 4, the down payment dilemma, how to save without sacrificing everything. This is the step that trips up most aspiring homeowners. The down payment. The myth that you need to put 20% down is one of the most damaging ideas in real estate. For a $400,000 house, that's $80,000 in cash. For most of us, that's a mountain that feels impossible to climb. So let's be clear, a 20% down payment is great, but it is absolutely not required to buy a home. So how much do you really need? Many conventional loans for first-time buyers let you get in with as little as 3% down. On that same $400,000 house, 3% is $12,000. That's still a lot of money, but it's a way more achievable goal than $80,000. Government-backed FHA loans are super popular because they allow a down payment of just 3.5% for anyone with a credit score of 580 or higher. And if you're a veteran or service member eligible for a VA loan or buying in a designated rural area with a USDA loan, you might be able to buy with 0% down. Zero. Now let's talk about the elephant in the room. Private mortgage insurance, or PMI. If you put down less than 20%, your lender will require you to pay PMI. It's an extra charge added to your monthly payment that protects the lender if you default. People see PMI as a penalty, a waste of money. But think of it as a tool. PMI is what makes it possible for the bank to give you a loan with a small down payment. It's the fee you pay for the privilege of buying a home and starting to build equity now instead of waiting years to save up 20%. And the best part, on a conventional loan, PMI isn't permanent. Once you have 20% equity in your home, you can ask to have it removed. On top of the down payment, you also need cash for closing costs. These are the fees for finalizing the loan, and they typically run about 2% to 5% of the home's price. For a $400,000 home, that could be anywhere from $8,000 to $20,000. So realistically, you're looking to save somewhere between 5% and 8% of the home's price to cover everything. How do you save that kind of cash? 1. automate your savings. This is the #1 most effective trick. Go back to that budget you made. Figure out a realistic amount you can save each month, even if it's just $100, and set up an automatic transfer from your checking to a separate savings account. Have it happen the day after you get paid. You can't spend what you never see. 2, open a high-yield savings account, HYSA. Don't let your down payment money rot in a regular savings account earning nothing. And HYSA offers a much higher interest rate, so your money is actually working for you while it sits there. 3, do a spending audit and redirect. Look at your budget again. That daily $7 latte habit, that's over $2,500 a year. Those streaming services you never watch, cancel them. Think of it not as giving things up, but as a direct investment in your future home. 4, leverage found money. Get a tax refund, a bonus at work, a cash gift. Make a rule that all unexpected money goes directly into that HYSA. Don't even let it touch your checking account. 5, visualize your goal. This sounds cheesy, but it works. Print out a picture of a house and color in a brick for every $100 you save. It makes the goal feel real and keeps you going. Saving for a down payment is a marathon, not a sprint. But by knowing the real numbers and using a consistent automated strategy, you can turn that impossible mountain into a series of manageable hills. And in the next step, we'll talk about the secret weapon that helps you climb even faster. Step 5, the secret weapon, unlocking down payment assistance. Okay, you're saving, you're fixing your credit, your DTI is looking better, but there might still be a gap between what you have and what you need. This is where we bring in the single most powerful tool for first-time home buyers, down payment assistance programs, or DPAs. There are literally thousands of these programs all over the country, and they are designed for one reason: to help people like you bridge that gap and get the keys to your first home. So what are they? DPAs are programs usually run by state or local governments that give you money for your down payment and closing costs. This help can come in a few different flavors. Grants, this is the holy grail. A grant is a gift of money that you never have to repay. Forgivable loans, this is super common. You get a loan for your down payment, often with 0% interest. If you live in the home for a certain number of years, say 5 or 10, the loan is completely forgiven. If you sell before then, you might have to pay it back. Deferred payment loans. This is a loan where you don't have to make any payments until you sell the house or refinance. It just sits there quietly as a second mortgage. Low interest loans. Some programs offer a second loan for your down payment that you do have to pay back, but with a very low interest rate and an affordable monthly payment. The amount of help can be huge. For example, the Georgia Dream program can offer up to $10,000 to buyers, and even more for people in certain professions. In Atlanta, some programs offer up to $20,000 or $25,000 as a loan that's forgiven after you live in the home for 10 years. California's Cal HFA Dream for All program has offered up to 20% of the purchase price. These are just examples, but there are similar programs in practically every state, county, and city. They change all the time, so you have to look for what's available in your specific area. So how do you find them? The first step is to talk to a good mortgage lender who has experience with first-time buyer programs in your local area. They are the experts. Generally, to qualify, you'll need to be a first-time home buyer. But this definition is often broader than you think. Usually, it just means you haven't owned a home in the last 3 years. Within income limits, these programs are for low to moderate income households, but you might be surprised at how high those limits can be, especially in expensive areas. Within purchase price limits, the house you buy also has to be under a certain price. Willing to take a class, many programs require you to take a home buyer education course. This is actually a huge plus. They are packed with valuable info. Imagine you save $10,000. You find a $300,000 house and you need about $19,500 for the down payment and closing costs. You're $9,500 short, but then you find a local DPA program that gives you a $10,000 forgivable loan. Suddenly, you're not short at all. You have enough to cover everything. This is how you buy a home without breaking the bank. These programs are the bridge. Don't assume you make too much money. The only way to know is to ask. Step 6, getting the green light. The power of pre-approval. You've got the right mindset, you've analyzed your finances, you're working on your credit, and you know about the secret weapon of DPAs. Now it's time to make it real. The next step is getting pre-approved for a mortgage. A pre-approval is an official letter from a lender stating that they are ready to lend you a specific amount of money based on a deep dive into your finances. It's so important to know the difference between a pre-qualification and a pre-approval. A pre-qualification is just a quick, informal guess of what you might be able to borrow. It's not worth much. A pre-approval is the real deal. It means you filled out a formal application, provided all your documents, and the lender has pulled your credit. Why is this so important? 1, it sets your budget. A pre-approval tells you exactly how much house you can actually afford in a lender's eyes. This stops you from looking at homes you can't buy. 2, it makes your offer powerful. In today's market, sellers won't even look at an offer without a pre-approval letter. It shows them you're a serious, qualified buyer. 3, it uncovers problems early. The pre-approval process might find a red flag you didn't know about. It's much better to find and fix those issues now than to have them blow up your deal at the last minute. To get pre-approved, you'll need to gather your documents. This is why step 1 was so important. You'll have most of this ready. You'll need pay stubs, W-2s, tax returns, and bank statements. You'll submit all of this to your lender. They'll pull your credit. And if everything checks out, they'll issue you that golden ticket, a pre-approval letter, usually good for 60 to 90 days. One huge piece of advice: once you are pre-approved, you must freeze your financial life. Seriously, don't make any large purchases, don't finance a car, don't open new credit cards, and don't change jobs without talking to your lender first. Any big change can put your final loan approval at risk. Getting that pre-approval letter is a huge milestone. It's the official green light. It's the lender saying, yes, you're ready. It transforms you from a house dreamer into a house hunter. Section 8, Step 7, building your A-team, the people you need on your side. Buying a home is not a solo mission. It's a team sport, and the quality of your team can be the difference between a smooth ride and a total nightmare. You need to recruit 2 key players for your A-team, a great mortgage lender and a fantastic real estate agent. Let's start with the lender. Choosing the right one is crucial. A great lender is more than just a money source. They're your financial guide. They will take the time to educate you, answer your questions, and find the best loan and down payment assistance for you. Don't just go with the first bank you find online. Shop around, talk to at least 3 different lenders, maybe a big bank, a local credit union, and a mortgage broker. A mortgage broker is often a great choice because they can shop your loan application to dozens of different lenders to find the best deal for you. Ask them questions like, what loan programs do you specialize in for first-time buyers? Are you an expert on the down payment assistance programs in this county? What are all your fees? Who will I be talking to during this whole process? You're looking for someone who is responsive, patient, and makes you feel empowered, not stupid. The second key player is your real estate agent. This person is your guide on the ground, finding homes, writing offers, and negotiating for you. A great buyer's agent is your advocate and your strategist. Just like with lenders, get referrals and interview at least a couple of agents. You need to find someone you trust and click with. Ask them, how many first-time buyers have you helped in the last year? What's your strategy for finding a home and winning an offer in this market? Can you walk me through the whole process from offer to closing? A good agent will listen, respect your budget, and never pressure you. They should be a skilled negotiator who will fight for you. With a strong A team in your corner, you can move forward with confidence, knowing you have pros guiding you every step of the way. All right, let's bring it all home. We started with that feeling of being stuck, just watching your money vanish into rent. We changed our mindset from renter to homeowner in training. We walked through the 7 concrete steps: doing a financial MRI, mastering your credit, trimming your DTI, saving for a down payment, finding assistance programs, getting pre-approved, and building your team. The path from renting to owning isn't some secret for the rich. It's a process. It's a series of small, deliberate steps that, when you take them consistently, build a foundation strong enough to hold up your dream. It takes discipline and patience, but it is 100% possible. Think back to the start of this video. The idea of owning a home might have felt impossible. Now you have a roadmap. You have a plan. You know what questions to ask, what numbers matter, and what mistakes to avoid. That feeling of being trapped can now be replaced by a feeling of empowerment. You are in control. Your journey starts today, not next month, not next year. Today, take the smallest first step. Pull your credit report. Track your spending for just one day. Open that high-yield savings account and transfer $20 into it. The momentum from that one small action is what will carry you all the way to the finish line. Homeownership is so much more than a place to live. It's building wealth, creating stability, and having a space that is truly yours. You have the tools, you have the knowledge. Now it's time to go build that dream. Thanks for watching. If this was helpful, please give it a thumbs up and subscribe for more. If you have any questions, drop them in the comments. I'll do my best to answer every single one. Now go take that first step.